For every dollar earned in the United States, about 1/3 goes to the government. In 2015, the federal government raised around $3.25 trillion in taxes. Of the tax money collected, about 2/3 of that is collected by the federal government, and about 1/3 by state and local governments. But where does this money come from? For example, how much of it comes from the sales tax you pay at a store? This pie chart shows the different sources for tax money. Just about half of it comes from income taxes. That's this big portion here. These are the taxes that you pay every April 15th on all the income you earn during the year. So if you have a job, a portion of what you earn gets taxed. How much gets taxed? This figure shows the tax rate schedule in the US. This figure shows what is called the marginal tax rate, the tax rate that you pay on the next dollar of income. So when you first earn income, for each dollar you earn, you pay 10 cents to the government. But the marginal rate rises as your income rises. So the richest folks, earning more than $465,000 a year, pay almost 40 cents to the government for every dollar earned above that level. This is what we call a progressive tax system. The richer you are, the more of your income you pay in taxes. So that's the federal income tax. The next most important source of taxes is payroll taxes. That's this area here in the pie chart. This is a tax that's also imposed on all your earnings, but it's not progressive like the income tax. Everyone pays the same percent. It's usually around 7% of earnings. For example, if you look at your pay stub, you'll see there's a line for FICA taxes and for Medicare taxes. These taxes pay for programs like Social Security that provide you income when you're older, and Medicare, which provides health insurance when you're older. We'll discuss these programs in a few lectures. They're very important, but also very expensive. The third most important source is corporate taxes, taxes on the earnings of corporations. That's this area here. There's a flat tax at 35% of the profits of corporations in the US. So if the retail firm LL Bean earns $1 billion this year, it would have to pay $350 million to the government. Another source of government revenue is consumption taxes, taxes on sales of goods and services, like a general sales tax, or specific excise taxes on goods such as cigarettes and alcohol. You might notice when you buy something at a store, there's a line in the receipt that lists a tax. That's the sales tax. Unlike income and payroll taxes, the sales tax isn't based on earnings, but on how much you spend. And then there's the property tax. This is a tax based on the value of our homes. It's what we call a wealth tax. It's not based on what you earn, like an income tax, or what you spend, like a sales tax. Instead, it's based on the amount of assets you have. Income taxes, social insurance contributions, and corporate taxes are mostly collected by the federal government. Consumption taxes are mostly collected by state governments. And property taxes are mostly collected by local governments. Now, there's no natural law that says our taxes have to be set up that way. Indeed, it's interesting to compare our taxes with those of other major countries. In fact, other countries collect much more of their taxes on consumption and much less on income. If you travel to other countries, they'll have a VAT, or value-added tax. This is basically like a sales tax. For example, we saw that in the United States, we get just under half of all tax revenue from an income tax and about 20% from sales taxes. In Korea, it's flipped. They get just 15% of revenue from an income tax and 31% the value-added tax. In Norway, it's much more even. They get about 25% of revenue from an income tax, about 25% from a VAT. But the bottom line is, there are many different ways that individuals are taxed in the US and around the world. In the next lecture, we'll talk about how these taxes affect people's behavior.